let's jump right into this with a few comments from JP Morgan Chase CEO Jamie Dimon. He said that the U.S. economy is still doing okay, but will be dragged into a recession along with the rest of the world in 6 to 9 months with another 20% downturn in these markets. Are you seeing the same things, that a worldwide recession is imminent?
I am seeing the same things. Now, we talked a couple of weeks ago about black swans. They're out there, and one of them surfaced, and that was what happened in the UK with their pension funds. So those kinds of systemic issues are out there, and that's the tip of the iceberg. So I think the market is aware, investors are aware that there's stuff that's out there that is breaking is going to cause investors to continue to go to the sidelines as long as they can get 4+% going into 2 years or a 1 year treasury risk free. They're going to be continuing to do that. And that means money coming out of the market. My low for the market, worst case scenario, this was back before we hit the June lows, was 2,600, which from the peak in the S&P is about a 45% move. I still think we can get down there. It would be ugly getting there from here. So 20% lower from here isn't far off my mark. And the headwinds are so severe. Investors are so nervous that sometimes when you look at stocks and the market is going down, there are no bids. It's very hard to fill an order if you're trying to sell something in quantity. There just aren't any substantial bids out there. And that's pretty frightening for investors who haven't sold and are still sitting on large positions.
Let's talk about a couple of those risks, because Dimon noted some of the catalysts driving us toward a recession. They include the impact of runaway inflation, interest rates going up more than expected, the unknown effects of QE, and Russia's war with Ukraine. Do you think Dimon's laying most of the blame with the Fed, and is he wrong if he is doing so?
I don't perceive what he said as laying blame at the Fed, though he's rightly could and should, but being a big bank, a constituent of the Fed, that one of the big banks that owns the privately held Federal Reserve System, he's not going to bash the Fed because the Fed is always there to save the big banks, and that's why it was brought into existence in the first place in 1914, period. So yes, should he disparage the Fed? Yes. Will he? No, never. What the problem is the Fed. This is like having the firemen come and put out the fire that they started. And as they're pouring water on the roof that is on fire, they're going to soak that all the way down to the foundation. And that's when we're going to have a systemic problem. That's the problem with the Fed, that they exist.
Okay, but here's the thing, Shah. If you cause the crisis and then you fix the crisis, they give you a Nobel Prize now, right? So obviously, that's all you need to do is just make the situation worse. All right, kidding aside, Dimon also noted that Europe is already in a recession. So how does that impact us here in the United States?
Well, I don't think that we're going to get away scot-free if Europe is in a recession. And I would say technically they are. Mechanically, they most certainly are. And I think that Asia is on the borderline of worse than a recession. And that's going to pull the global economy down. And that the U.S., though it will once again be the cleanest dirty shirt in the laundry, is not immune to global economics and trade. We're having bilateral fights with China. We're going to have bilateral fights elsewhere. We're going to have it with the Saudis, I think, in not too short a future. So we're going to have a lot of issues, and that's going to create some real trade tension problems. That's going to crimp supply chain stuff. So inflation isn't going anywhere. And as we start to see recession take hold, investors really need to buckle down. It's going to be a tough ride.
When do you think we would head into a recession? And are you making any trades positionally as we get closer to that date?
Well, we're taking positions now in both the Money Map report and also in Hyperdrive portfolio. The way to play this is pretty straightforward. You play it from the short side, from the downside. We're in a bear market. Once in a while, you can find pops off the June lows, for example, coming into expiration, monthly, big quarterly cycle expirations, when dealers are going to try and move the market higher to get the puts that they sold to come back to them, and they end up keeping the premium. You're going to see pops like that. And those are opportunities for us to get into the plays that we want to get into, to buy puts, to buy put spreads on these zombie companies, and also on the market. And we're buying puts and making other plays on mortgages, on currencies, on other economies. So there's just opportunity out there galore right now, as long as you're playing from the right side. And the trend is your friend. The trend is down, people. That's where your friend is, and that's where you play it from.
Shah, I wanted to ask you a quick question, something that I read yesterday, because I think you could speak to it. And this came from Scott Menard of Guggenheim and Guggenheim Partners. He said that now, in the middle of a sea of change in the financial markets, most of the professional talent that manages this complex global network, asset managers, market makers, financial advisors, bond issuers, macro prudential regulators, and central bankers, have little to no experience with the market volatility associated with the sea of change in global policy, whether it's monetary, fiscal, or geopolitical in nature. Do you think we have a competency problem?
First of all, what I have to say about that is, wow, absolutely nailed it. That's the truth. And I've been in this business actively as a professional trader starting out in 1982 on the floor in Chicago. And so I've seen a lot of stuff, but I don't think anyone's ever seen this. But all of the newer folks who are certainly half my age, they've never come close to seeing anything like this. And certainly I don't think the world has seen anything quite like this. So no, we don't have I say the talent pool. We certainly don't have the right folks deployed because they're going by old rules in markets that don't exist anymore. The mechanics of the stock market, for example, have completely changed, and investors and traders who don't understand that, and certainly policymakers and of course politicians, don't get what the dangers are, and they're out there now. And I'm talking about systemic dangers.
Absolutely. And one thing to keep in mind, I'm 41 now. No one who is in my generation has traded in an environment of plus 3% interest rates. So that's kind of what we're up against, and that's one of the things why, if you've been through this experience and you've seen it, and so many other people didn't, that is what your key advantage will be moving forward, because the lack of experience is what you're going to be able to play into.
I'm going to say something that you should never say, but I'm going to say it. This time is different.
Yes, absolutely. All right, let's get into JP Morgan real quick, because they, along with a number of banks, are reporting earnings on Friday. We have Goldman Sachs on Tuesday. What are you expecting from the reports this week and next?
I'm expecting to see a little bit of pain. I think on the trading side for the big banks that trade, they should have had a good quarter, because the kind of volatility pretty much to one side, it was up and down for sure, but generally they do very well in markets like we've seen over the last quarter. I'd be surprised if there were misses on the trading side of things. The investment banking side of the banks are going to get hit. What I'm going to be watching for, and I think everyone's going to be looking at, what are they going to do with loan loss reserves? How much are they going to add? And that's going to tell us what kind of condition the consumer is, what kind of condition their loan books are in. And we see that already in Goldman Sachs. Goldman Sachs is already going to take a loss on its consumer division, about $1 billion+. And that's going to, if it's worse than that, they've lost about a cumulative $4 billion on Marcus and their consumer facing, that consumer facing side of the bank, because the margins aren't there, and they do a lot of subprime stuff. So we're going to start to see where some of the breakage is in some of these big banks. Wells Fargo, a bank that I made a lot of money on a couple of years ago, riding it up. I now want to play that from the downside. The mortgage business, the slack in the mortgage business is going to kill them yet again. They still have management problems, which is frightening. And so the banks, I think, are going to be, the weight on the banks is fairly heavy. They're going to have to beat well above consensus for their stocks to have any kind of pop here. Otherwise, I think they all could go a good bit lower.
One last thing, everybody, to keep in mind with these banks, with everything that's transpiring around the globe with Russia, pay very close attention to the cybersecurity costs of these banks. That remains a big, distinct challenge in the financial sector. Shah, are you setting up any trades around earnings before earnings, or will you wait until the reports come in?
We're going to probably put a couple bank trades on Thursday for the big numbers coming out on Friday. J.P. Morgan, Citi, and I think Bank of America. We're targeting Citi and J.P. Morgan. Again, to the downside. I don't think they're going to surprise enough to the upside. If they do surprise better than consensus, I think when investors look into their actual particulars, and when we hear guidance, which is not likely to be positive, Jamie Dimon coming out yesterday and talking about market 20% down, that's a warning, folks. He's talking his book.
Absolutely. Shah, thanks so much for joining us today. As always, stay tuned for a preview of the Warlock's World at 9:15. Well, it's 9:16 right now, so we're eating into that time. Be sure to join me at 12:30 for midday momentum and for the world's biggest trade. Everybody have a great day of trading. We will see you all day today. Money Morning Live.